Welcome back to another video here on Financial Friends. Today, I have an update to the dividend portfolio for you. I also want to talk about all of the earnings that are coming up over the course of this next week and also some earnings that have already hit. So, before we get into the video, if you could go ahead and hit the like button down below. It's quick, it's easy, and it's free. It helps push this video to more people. Also, at any point during this video, comment your thoughts. I want to hear your thoughts. I'll be replying to everybody down below in the comments or giving your comment a like and a heart. And also go ahead and hit subscribe. I appreciate you guys a ton. Looking to grow this family, this community friend group to 1,000 members. So go ahead, hit subscribe. We are on the road to that 1,000 mark. And without further ado, let's go ahead and dive into the video. So, first things first, I updated the portfolio. Of course, I bought more stocks over the past week. I actually made purchases to every single position in the portfolio. A $5 purchase was made in every single position except for Realty Income and SCHD. There was a $10 purchase for Realty Income and a $15 purchase for SCHD. It actually held the dividend yield steady at 2.72%, raised our yield on cost by 0.01%. Our July income did go up by 3 cents, and our total annual income went from $27.55 to $29.31. Of course, I love seeing that number go up. I also want to point out I do make these purchases. This is a real portfolio. I know I don't always show actual fidelity information a ton. I have pulled it up before in the past. I don't want to show my account number in the thing, and I also don't like the fidelity interface too much. I like to use the dividend tracker as well. There's a link down below. I've made videos in the past. Shameless plug, but this is a fantastic website. Go ahead, use the referral link. It does help support the channel. Anyways, these are all the purchases. You can see I did actually make them. I made them all on the same day, July the 21st. Okay, cool. So that there is updated. Let's go ahead now and cover Pepsi earnings. These happened back in July, and I'm sorry, it's still July, back on July 12th. And a lot of you guys might be thinking, okay, you don't own Pepsi stock, and that's correct. I don't directly own Pepsi stock, but we've talked many times before. It is one of the largest position, currently the second largest position within the SCHD ETF. PepsiCo, you could see here, makes up 4.33% of the assets held within this ETF. And so it's a very large, although this is of course a very diversified ETF, it is a rather large portion of it. And so I do want to keep an eye on how Pepsi is doing. Not only that, but it does signal the strength of the consumer, which is directly tied to a lot of the positions we hold, particularly Procter & Gamble and sort of indirectly Apple, John Deere, and even a little bit there with 3M in terms of their Scotch division. Regardless, I'm derailing here. PepsiCo earnings are here. You could see the company reported $1.86 adjusted earnings, which did beat expectations, and $20.23 billion of revenue, which also beat expectations. Now, they did have a second quarter income of $1.43 billion, which is $1.03 per share. It is down from a year earlier. Now, I think a year earlier, we can all assume that consumers were a little bit stronger, fresh off of pandemic stimulus checks, raging consumerism, right? We all wanted to get back out and start doing things. And now in 2022, life is shortly or quickly rather, kind of coming back to reality. In addition with the fact that we just don't have as much money to spend anymore. There's also increasing costs for Pepsi. They do expect costs to continue to rise. So a little bit of softening here in expectations in terms of, yes, we do think that things are going to continue to get worse. Margins did slim, but people were continuing to pay for things like Doritos and Gatorade, which I think people will always pay for. They did admit, like, yes, we are kind of shrinking a little bit. They are reducing the amount of chips in bags and things like that. And they are also feeling the pressure from Russia and Ukraine, particularly in Russia, with some big hits there. A $1.17 billion charge related to that conflict. they did continue to see growth in specific areas. Frito-Lay saw 14% revenue growth. They also saw 5% net sales growth. So of course they're seeing net sales growth. They're not seeing that there on the bottom line in terms of income. So costs are increasing there in between. Just something to note as we continue to move forward. I like SCHD. I'm going to continue to make investments in it. Pepsi is a small kind of part of the broader picture of the portfolio, of course, but it's always good to stay up to date on what exactly is happening in the world of dividend companies. Next up, a direct owner of Johnson & Johnson, so we do want to keep a really sharp eye here. They did report pretty good earnings, $2.59 per share, which was a 5-cent beat on the $2.54 expected. They also beat on the revenue side. I know that is buried somewhere in here, but I can quickly pull it up because I made a post about it on public. Revenue beat of $24.04 billion versus the $23.82 billion expected. We do like to see that, a beat on the top and the bottom line. Now, their adjusted sales look good. Okay, a 12.4% increase in pharmaceutical, 2.9% increase in consumer health, and a 3.4% increase in medical device sales. That, of course, all adjusted. And so you want to look a little bit further into the picture here. So pulling up this graphic that they did release, you can actually see that they reported a decrease in worldwide consumer health sales, a decrease in worldwide med tech sales, and still a very, very strong quarter in pharmaceutical sales. But you can see they are also saying they increased operationally. So you want to find out why. Well, you can see here that non-GAAP measures, so this is not generally approved accounting principles, right? This isn't something they can officially report. They have to include the official numbers, which is what they are reporting here, these decreases. But non-GAAP measures exclude the translation of currency. And what that means is this 3.4%, if they're excluding the fact that they have to translate currency from euros or whatever they are selling their products in back to US dollars, they are increasing in sales. But because they do have to revert back to US dollars, they are actually losing in sales, if that kind of makes sense. And so you want to look a little bit further into that because they actually decreased and guided a little bit down in earnings per share for the full year because of the strengthening of the US dollar. We've continued to hear about parity between the euro and the US dollar. Well, the US dollar in relation to other foreign currencies is getting stronger. And I did a little bit of digging because this is something I haven't quite ran into yet as an investor. And you can see here on Investopedia, one of my favorite websites, I always talk about it, the US dollar is considered strong when it rises in value against other currencies in the foreign exchange market. So a strengthening US dollar means it can buy more of a foreign currency than before. So when American companies that rely on exports or global markets for a lot of their sales, it will actually hurt them. And that's what we are seeing here with Johnson & Johnson. The US dollar is strengthening. They do a massive amount of international sales, and therefore they are guiding down this full year earnings per share from the previous $10.15 to $10.35 range down to $10 or $10.10. Something that overall doesn't really affect me. I'm not worried about it. I'm going to continue to invest in Johnson & Johnson because they actually said that really the only reason why we're cutting it is because of this currency fluctuation. You can see the quote here from CNBC that the CFO of the company, Joseph Wolk, said 100% entirely on currency fluctuations, really because of the euro and the dollar. Moving forward, we have a ton of earnings coming up, and I literally mean a ton of them. Anything that is circled with this little circle here are companies we own within the portfolio. So we will see Wednesday, Thursday, and Friday direct reports from companies we own in the Dividend Journey portfolio, and then indirectly Coca-Cola, Merck, Pfizer, and Altria will also be reporting. As we touch back here on SCHD, you can see Merck, 4.29% of assets, Texas Instrument, 4.29% of assets, Coca-Cola, 4.15% of assets, Pfizer, 4.07% of assets, and then Altria here at 2.73% of assets. Also, I realized that I had a lot of earnings updates on my Fidelity kind of screen, and I was sitting there thinking, going, what is going on? Well, not included in the earnings whisper anticipated earning releases was none other than Hershey, which we do own in our portfolio and will be reporting earnings on Thursday, July 28th, but also 3M, which makes up a significant portion of our portfolio and of SCHD, clocking in here at 2.68%. They will be reporting earnings on Tuesday, July 26th, the day that you are watching this video. So that is the whole portfolio update. There is a lot going on. You will see another update next Tuesday on how all of the earnings played out over the course of this week. I do hope that you enjoyed this update. I hope you were able to learn something new. Let me know in the comments if you made it this far. What companies are you looking forward to? What reports are you looking forward to? I will more than likely have a video out on Thursday regarding the craziness that is going on in the market, so stay tuned for that. We have a jam-packed week of earnings, GDP results, FOMC meetings, interest rate increases more than likely, and a ton of other things. So stay tuned. Leave a like down below. Thank you all for watching and have a great day. Bye-bye.